Well, good morning and welcome again to our latest webinar. My name is Mike Foster. I'm the Commercial Director at Chapman Robinson & Moore, and I'll be asking the questions today of our interview with. And this latest interview to kick off this series is with our Technical Director, Alan Sowden. Some of you, I'm sure, have heard Alan speak before, either at events or maybe for some of our own seminars that we run here in Oxfordshire. But we welcome you to this webinar. Just want to make sure, first of all, that everybody can hear me okay. So would I mind, on the right-hand side, you should see a chat box. If you could just put a Y or a yes in that chat box to make sure that you can hear me, that would be fantastic. Thank you. So I'm not talking to myself. That's good news. So again, welcome to the webinar. Today, really, the format is we've got some questions that we've received in advance that I'm going to pitch to Alan, and then Alan's going to share his expertise with us, not necessarily just giving us the textbook answer, but also hopefully giving us some sort of practical tips and guidance, so obviously putting him a little bit on the spot there. So without further ado, I will go to our first question. And I thought we'd put the questions on the screen so you could read them and has them as a reference as well, but I will just read them for Alan's sake. So, my tax bill is January 2018, was significantly higher than it used to be. I know this is because of taxes on dividends being increased. Does this mean I should reconsider how I take money out of my company? So, Alan, I'll hand over to you.
Thanks, Mike. So, we think this person obviously has their own company, take the bulk of their income out as dividends, which has always been the most tax efficient way to take the majority of income. They've completed their tax return for 17-18 and have found they've got a big increase in their tax bill. Now, people generally know that from 16-17 there was an increase in the taxation on dividends from an effective rate of 0% to 7.5% for a basic rate taxpayer, and from an effective 25 to 32.5% for higher rate taxpayer, so effectively a 7.5 increase across the board. There is an exception where the first £5,000 is free of tax currently, although this is due to drop to £2,000 from April 2018 onwards. So in other words, we have 2 years of 5, then dropping to do. So although this has reduced the benefit from a tax perspective of paying dividends as opposed to salary, it's generally sort of the more efficient route. It's just squeezed the difference slightly. Reason being is saving 13.8% employers' national insurance and a 12% employees' national insurance contribution, which would, the employee side does reduce to 2% once you're over about 45k salary. So to put some real numbers into it, for a basic rate taxpayer with a company making £100 of pre-tax profit, you'll be left with £75 in your back pocket after paying the corporation tax and personal tax, assuming you've already used up your 5k allowance. If you're paying a salary, then from that £100 profit, you're left with only £60 after paying tax and employee and employer national insurance. For a higher rate taxpayer, the figures are £55 net for dividend income and £51 for salary, assuming you've already paid the maximum 12% NIC. If that's not the case, then you'll only be left with £41 after the £100 pre-tax profit. So you can see, although the benefit has eroded slightly, the dividend profit extraction is still a more efficient route. So notwithstanding the fact that the tax has gone up, we then look to how we can mitigate these changes, and we generally look at these sort of perennial topics of whether there's a possibility of involving family members in share ownership. We'd always recommend, if that were the case, that we use a minority of shares, particularly if we're looking at the sort of classic non-working spouse or very limited involvement spouse in the business. Although legally you can go up to a 50-50 shareholding, it's something HMRC don't like. They do pick test cases to challenge, and although they've always lost them, I don't know anyone that wants to be dragged through the high courts by HMRC being the test case, even if they ultimately win. There's no real winner there. Also, practically speaking, for passing certain resolutions, etc., you need less signatures if other people have minorities of shares. So if we considered splitting the shareholding around the family, we also start to think about are there any more tax efficient or tax-free ways to take money out of the company. So for example, if you pay into a pension, or if you want to pay into a pension, should you consider the company making that employer contribution rather than you paying tax and or national insurance and then making a personal contribution? Are there some benefits in kind which, although taxable, might work out to be cheaper to pay through the company? So an example is healthcare costs, which everything else being equal, if the premium is the same, can actually save around 10% of policy costs by going through as a benefit in kind compared to paying tax and paying the insurance out of your net income. The downside is it does need to be declared on a Form P11D each year, and obviously if you don't make that declaration there are penalties payable. And also to think about the tax-free benefit in kinds if applicable, so things like childcare vouchers, cycle schemes and medical checks as opposed to medical insurance, which can be paid tax-free. Also, the kind of softening of the blow is the January 2018 payment that our listener has just made is the worst one, because they've got the double whammy of not only has the tax gone up, so you've got a large balancing payment to make, but the payments on account have gone up as a consequence. So by the time we get to January 2019, they've already made 2 larger payments on account, so there shouldn't be a big balance to pay unless income is higher, in which case you would always expect a larger tax bill. Okay, so hopefully that answers this question. I'll pass you back to Mike.
Thanks, Alan. So I suppose before we move on to the second question, because again, sharing some invaluable expertise with us, just tell us a little bit of your background, some qualifications, etc., just to make sure that the people that are listening today that know that they are listening to an expert, not just you're reading it from a book.
No problem. Thank you, Mike. As you said, I'm Alan Sowden. I'm the Technical Director here at Chapman Robinson & Moore. I've been with the firm for 19 years, which makes me older than I think I am. I qualified ACCA many years ago and then went on to study my Chartered Tax Advisor exams following that. So I'm a fellow of the ACCA and a member of the Chartered Institute of Taxation, and I'm generally responsible for dealing with and advising on the more complex tax issues across the board within our firm. And as Mike said earlier, I've done some speaking, both internally within our educating other accountants, speaking more wider at conferences, and also our own business builder forums and seminars, which some of you might have heard in the past. Okay, I'll pass it back to Mike and see about our next question.
Excellent. So there is an opportunity for you to ask your question of Alan. So if you do have a question at any time, or you just want to recap on a point, then just please drop a question or a comment into the chat box, and I'll be keeping an eye on that as I'm asking the question. We'll take the second question from Alan, which is I have buy-to-let properties and have been told that my tax bills will be going up. Why is this, and how can I mitigate this? Certainly a question we get quite often from our clients, Alan. So.
Thanks, Mike. Yeah, absolutely. This is something we're getting asked quite a lot, and we're trying to advise people proactively on as well. So what the issue is here is where people have buy-to-let portfolios which they own personally. Up until now, virtually, where you've had mortgage interest or other borrowings, you've been able to offset those against your rental income as a cost that you'd expect. It's the economic reality. And then you pay tax on your net profit. So that's always been logical, readily understood, and the status quo. Under the new rules, which are being phased in over 4 years from 2017-18, in other words, the tax year we are in today, this whole concept is changing. Once these new rules are fully implemented, which is from 2020, you pay tax at your marginal rate, which might be 20, 40 or 45%, or a combination of them, on your rental income before considering the interest cost. You will then get a reduction in your tax liability of 20% of the interest you've paid. So although you will still get tax relief on the interest, it will be restricted effectively to basic rate tax irrespective of what rate of tax you actually pay. At the moment, you automatically get tax relief at your highest rate because you only tax on your net profit. So it's easy to think that this is an issue for higher rate and additional rate taxpayers, but in fact I've seen cases where basic rate taxpayers are affected. The reason for this is the mechanics of the calculation are such that someone who's currently a basic rate taxpayer, once you strip out that rental cost if they've got quite high borrowings, ends up being a higher rate taxpayer with only then the basic rate reduction from the interest. We've got some quite in-depth examples, in fact, on a fact sheet which we've written on this subject, and it's available freely to download on our website, crmoxford.co.uk, in the news section. So anyone that is affected, I'd unbiasedly, wholeheartedly recommend reading through that fact sheet. But I've got an example here from that in front of me. So in this example, Ian's got employment income of £40,000. He's got rental income of £12,000 before considering mortgage interest, and mortgage interest of £10,000. In 16/17, Ian's just paid tax on his £2,000 profit, difference between income and mortgage interest. He's just in the basic rate band, so he only pays 20% on £2,000, which is £400. Under the new rules, the £12,000 gets added onto Ian's income. He pays £3,000 at 20% and £9,000 at 40% because he's into the higher rate bracket. Then from that, he gets to deduct 20% of £10,000, which we can probably all work out as £2,000. So his tax liability overall is £2,200. And let's recap, his economic profit is only £2,000, being £12,000 income less £10,000 mortgage interest. His effective tax rate is 110%. He was previously paying 20%. Now obviously this is someone who's quite highly geared, but that's not an uncommon scenario with buy-to-let properties. So whilst that is a relatively extreme example, we can see the issue. In fact, a real quirk is where someone has a rental loss caused by interest. So say this guy's tenant has gone 6 months into the year and he's been spending time refurbing the property, and he's only got 6,000 income but still got 10,000 interest. He'll actually pay tax on his 6,000 income, which could be at 40%, and then get a 20% reduction on 10,000. So you can have situations where you actually pay tax on a loss. So these can be quite adverse consequences for people with buy-to-let properties, particularly where their interest costs are relatively high. So we've been asked how we can mitigate this. Now this is obviously a very complex area, so individual circumstances vary, but in a nutshell, there's a few options which can be investigated, and they won't all be suitable for everyone. Firstly, properties which you hold in limited companies aren't affected by these rules. So it's a good solution often for long-term investments which you want to hold, because a short-term property investment through a company can actually be tax inefficient. I won't bore people with the details now. However, if these are existing properties, you can have a capital gains tax charge and also a stamp duty land tax charge on transferring the properties into the company, so that might become very unattractive. On the flip side, for people who are looking at new investments, it's really key to take advice early on the best vehicle, because often making that new investment through a company will be the right route forward. Obviously not always in all cases. As an added benefit, the use of a company as a vehicle can leverage some good inheritance tax planning solutions where people are concerned about passing wealth down the family line. So again, by getting the structure right from day one, it makes the future planning much easier. Where that's not going to be appropriate for people who've got properties sitting at gains, they don't want to pay the capital gains tax. You could deleverage your portfolio by reduce the mortgages, and there's ways you could do this. You could start by switching an interest-only mortgage to a repayment mortgage, which obviously over the next few years would start to reduce the impact, because the lower your interest cost is, the lower the impact of these rules. And although you're going to pay more tax, you're going to have more money left to pay the tax out of. You might have other funds which you could use to repay the mortgage in whole or in part. So maybe that's from general savings, maybe there's an inheritance or some other source of capital. Or for someone with a portfolio, they might consider selling off one or more properties to pay off mortgages on other properties. Again, this will trigger a capital gains tax charge, but of course you've actually received the proceeds with which to pay the tax, whereas when you transfer the properties into a company, it's a cashless transaction, but there's a cash tax liability. And if within your portfolio you have furnished holiday lets or commercial property, then you could switch borrowings to these properties because those borrowings are not affected by these new rules. It's only residential lets. And finally, which often would be the first consideration, is could you transfer part or full ownership of properties to a spouse with lower income? There could be a stamp duty land tax cost if there's a mortgage, and it may not eliminate the problem entirely, but if the spouse has got personal allowance to utilise or basic rate band, it will certainly reduce the problem, if not eliminate it completely. So those are the four sort of generic options, but as I said earlier, I stress this is a complex situation which varies from individual to individual, so it's really important to get advice now for existing portfolios and before investing for any further investments. Okay, I'll pass you back to Mike.
Thanks, Alan. And hopefully you've seen some examples of Alan's advice, just not sort of textbook responses, but some practical guidance as well. So another question that I was asked to include when someone was registering was that my income is around 60,000, even though, sorry, frog in my throat. So my income is around £60,000, but even though my spouse doesn't earn enough to pay tax, we have all of our child benefit recouped as tax. What can I do about this? Certainly, I could have wrote this question myself. So, Alan, very interesting.
Absolutely, this is quite a common scenario, and in fact, many people who are affected will feel very unfairly positioned if they compare themselves to a family with two working parents who each earn 30,000, 40,000, who get to keep 100% of their child benefit despite having a higher household income. It always reminds me of something my old tax lecturer said many years ago, which is that tax has nothing to do with logic or fairness. So once we park that thought, we look at the law and how we can deal with this issue. The first step would always be to look at the income position as a whole and see whether any income can be diverted legitimately to a spouse. So there could be rental income, going back to our last question, there could be investment income, and there could be dividends from an owner-managed business. So is there scope to move income from the higher earning spouse to the lower earning spouse to get that higher earning spouse below 60,000, or ideally below 50,000, where the rules kick in? So for those who aren't aware, if your income's under 50,000, you keep all your child benefit. If your income's over 60,000, you repay it all. And then it's a sliding scale between the two. So if you earn 55,000, you repay exactly half of the child benefit received. So having looked at whether income can be moved from one spouse to the other, is there any investment income which could be turned non-taxable by either moving it into an ISA or by changing investments from producing interest or dividends to giving capital growth which we cash in, because that wouldn't be taken into account as income for these purposes, and in fact maybe more tax efficient anyway. Clearly there is an investment angle here which I'm not advising on. I'm purely talking about the tax aspects. You'll probably hear that disclaimer quite a lot. If we're unable to get the actual taxable income down to the 50k level that we need to, and there's not going to be a way of doing that regularly, we'd look to see if we can get halfway there by moving people's income so they, rather than have an income of bang on 60,000 every year and losing child benefit, can we alter things so that one year we have 70k of income and we lose child benefit, but the next year we have 50k of income and you get to keep it, so you're retaining 50% on average. So for someone who is in control of their own income because they pay themselves dividends through their companies, this is a potentially good solution. We can alter the timing of that and manage that tax efficiently. For someone who isn't in control of that, for example, because they're on a pay-as-you-earn salary with a a third-party employer, is there a way of timing their pension contributions such that, again, that because the pension contributions come off your assessed income for whether the child benefit's recoupable, if you had someone who had income of 70k and pays 10,000 a year into a pension, could they pay 20k one year to get that down to 50 and nothing the next, to mirror the situation with our dividend taker who was managing their income position? Again, obviously there are investment aspects to when you make your pension contributions, which are beyond my scope of expertise, but it's certainly a method of altering the position. On that subject, if you are in the bracket of 50 to 60k, further pension contributions or charitable donations, because they're treated the same, come very efficient. For someone with 2 children, the effective after-tax position is that it costs just under £50. It costs £49.24 to put £100 into the pension fund or to a charity for someone within that 50 to 60k bracket. As your number of children goes up, because your child benefit obviously goes up, the effective cost reduces further. And the purely mathematical answer is that once you've got 8 children, you actually get 100.63% tax relief on your contributions. So you're making 63 pence in every £100 that you put in. But you're probably too tired to deal with the paperwork, frankly, with 8 kids, so it doesn't really happen. But that's the maths behind it. Okay, so hopefully that answers that question.
Thanks, Alan. So we've got our first question actually coming on the chat. So the question that we've got coming on the chat box, Alan, is, as a startup, how would I decide if it's best to set up as a sole trader or a limited company? That's certainly a question we get quite often for our startups.
Yeah, that's great. Thank you for the question. Again, yeah, that's a really common question. As those of you who have heard me talk before will know, the answer is always to a tax question, it depends. I would say it never has been a purely tax decision, but with the extra increase to dividends taxation, which I mentioned earlier, even more so, it's less a purely tax decision these days. The actual tax position for someone who takes out most of their income from their business is quite close between limited company and sole trader. So we would then look and say, well, actually, what suits you? Is there a reason that you need to be limited liability for, to protect your personal assets from issues within the business, for reasons of what you might call prestige, so for people feel there's a certain scope which is felt that you're that size for a limited company. And on the flip side, often for a sole trader or partnership business, what we call mixed use costs, so for example, motor costs, phone costs, use of home as office, can be much easier to put a proportion through a claim tax relief on. Also, if a business is going to be loss-making in early days, having that loss in a sole trader or partnership business means we can carry that back and gain you often a tax refund of tax paid in earlier years, or to offset against any part-time salaried income. Now, if the business is expected to be profitable and someone doesn't necessarily want to draw all their profits, often that pushes things back towards being a limited company. Reason being, it prevents you paying higher rate tax on income which you don't want to draw. So if you had a business which was making, say, 100k profit, and your income requirement was 40,000, if you're self-employed, you're going to be paying a lot of 40% income tax and class 4 national insurance on money that you want to reinvest within the business, either to fund your debtor book or to purchase stock, or simply that you don't need the money and you're going to build it up for some further purpose. If you're in a limited company, you're only paying your 19% corporation tax on the profits you're not drawing as income, so you can then make some significant tax savings. So, as I said, there's a balance of factors, and it will very much depend on where those facts lie for the individual, and it's a personal issue, but hopefully that highlights the sort of generic considerations, pros and cons of both.
Alan, hopefully that answered the question. Certainly gave me some interesting information to take to the meeting a bit later. So question 4 then we had in advance. Although my wife and I hope to be around for many years to come, I'm getting worried about inheritance tax when I die. As well as our house, we have monies built up in cash and stocks, ISAs, 2 rental flats and our pension funds. Overall, our assets are worth around £2 million. The house is worth about 900,000. The rental properties are worth about 400,000 between them. Our pension assets are around 500, and we have 200,000 in ISAs. Interested to hear, Alan?
Again, this is not an uncommon scenario. £2 million sounds like a very big estate, but with property values in this area as they are, it's not uncommon for people to have significant inheritance tax burdens. And actually, often these things aren't planned for because people don't like to think about their own mortality. So it's positive that this person is starting to think about this, and actually can some planning happen now? And as with all tax planning, the longer you've got to plan, the better the outcome you can achieve. So in this case, the home is always the hardest thing to plan around IHT, inheritance tax IHT on. For these couples, as well as the nil rate bands, so for any individual, the first £325,000 which you leave behind is free of inheritance tax. And for married couples, you can now inherit each other's nil rate bands. So for a married couple, you tend to think about having a £650,000 allowance. Now there's also something called a residence nil rate band, which has now started coming into effect and is building up over the next few years, such that in, I think, 2020, off the top of my head, the residence nil rate band plus the nil rate band will be £1 million. And what this means is that it's an extra nil rate band which covers the costs, the value of your main residence. It's quite a complex area, but I'll just kind of in broad outline there. So for this couple, assuming that they're going to be around for a few years and this residence nil rate band fully comes into play, their main residence is going to be fully covered by their nil rate bands and resident nil rate bands. So that's out of the equation. We're now worried about the rental properties, the pension assets and the ISAs. Pension assets are actually outside of the estate for inheritance tax whilst they're undrawn. So it's quite interesting. This is relatively new rules which came in year before last. It was always a no-brainer when you reached your pension age that you take your 25% tax-free lump sum out of the pension, because why would you not have tax-free cash? But now we're in a situation where if you don't need that money, it's worth considering leaving that in your pension fund, because as soon as you draw that money out, that's within the scope of inheritance tax if you're not going to spend it. And if you need it to pay your mortgage off or for some other purpose, or to help the kids on the property ladder, or whatever the reason might be, obviously do take it. It's your money. If you're going to take it out and invest it, then I would suggest people consider leaving the money in the pension fund, because actually potentially you've got a 40% saving on that value there. And in fact, if someone inherits money from within a pension fund and the person who's passed away is under 75, that money can be paid out directly to the beneficiary free of all tax, which is incredibly generous, and there's no limit to this. So you could have hundreds of thousands of pounds paid out tax-free, inheritance tax-free, income tax-free. If the person who's passed away is over 75, then effectively it becomes a pension fund to the beneficiary. And whilst they can access that as soon as they wish, it will be taxed as income. But there's no inheritance tax, so you can control when any tax is paid on this. So for these reasons, and again, you should always speak to a good pensions advisor. For people accessing pensions, I would consider this inheritance tax position. So going into something like a phased drawdown, where you take lumps of money out of the pension fund rather than cashing it in for an annuity, will give you certain tax benefits. Again, there are non-tax considerations, but I'm here to sort of extol the virtues of tax planning fundamentally. So we're not worried about our 500,000 pension assets, so we're really worried about the rental properties and the ISAs. Well, with the ISAs, there are options again, excuse me, are some investment angles. you could put those ISAs into funds which qualify for something called business property relief. So these are things like portfolios of AIM, alternative investment market funds. You could put it into EIS funds, enterprise investment schemes. The advantage of this also is that if you put money into an EIS, you get an income tax credit of 30%. So if you put 10,000 into an EIS fund, you get £3,000 off your income tax bill. Obviously, you need to be paying at least £3,000 income tax in this example to get that back. And do consider the investment risks which you've got. There's no point saving inheritance tax and losing your money overall. And make sure we use our gifting rules. So we're allowed to make £3,000 annual exemption of gifts. Each year we can pay £3,000 immediately out of our estate for inheritance tax. And a much underused gift is ordinary gifts out of income. So if you've got someone who's got a comfortable pension income, say £25,000, they only spend £1,000 a month. They're building up 13,000 capital every year. They can give away that £13,000 capital every year, and it's immediately exempt from inheritance tax. And often this is used for things like school fees for grandchildren, or to help people, in a regular and controlled way. Alternative is literally just gift it as what we call a potentially exempt transfer and survive 7 years. So people have often heard about give money away, live 7 years, and it's outside your estate. It's the simplest form of planning. If you survive at least 3 years, you start to get a proportionate reduction in the IHT payable. The rental properties could be quite complicated. We've probably got an issue here that they're standing at significant gains. It's a bit like our point earlier with the rental portfolio. If they were to give those properties away, they could trigger a significant capital gains tax liability. They've still got a 7-year window where inheritance tax could be paid, and they're going to lose their rental income. It might be something they need. For these situations, there is an alternative structure where these properties can go into a family partnership, which is it avoids triggering any immediate tax charge. The income can be retained, and we're only left with the 7-year survival requirement. And one overarching thing I'd always talk about with inheritance tax is whether we're talking about gifts in our lifetime or gifts in a will. We should always think about whether those gifts are made absolutely, i.e. directly to the person, or into a trust, not necessarily for tax reasons, but for point of view of asset control. So we're worried about the beneficiary getting married and divorced, we're worried about them becoming bankrupt, or just being irresponsible with the money. That would always be a major consideration. As I say, very complex area, but that gives us the overview, hopefully. Pass you back to Mike.
Thanks, Alan. And so a reminder, if you've got a burning question that you'd like to ask Alan yourself, then please drop it into the chat box, and we'll ask it of him. Next question is question 5 that we have, which is, I own my own limited company and thinking of changing my car. Is it a good idea to buy this as a company car? If so, what should I do about the fuel? As I understand, this is subject to separate taxation. I'm sure this is a common question you either ask yourself or you get asked as an advisor yourselves.
Great, thanks, Mike. Yeah, this is a perennial topic. Year on year, we see the company car tax rates increase, both for the benefit of having a car and having the fuel paid for. A lot of people will know, but a lot of people won't, that the two factors which determine the benefit in kind, which is what you pay tax on, are the list price of the car when new, and that's even if you're buying the car second hand or at a discount, and the CO2 emissions of that car. The higher emissions, the higher the percentage of the list price you will pay your tax on. For most people, it's becoming a rule of thumb that it's uneconomical to run a company car where you've got a relatively high value or relatively high emitting car, which doesn't mean it has to be, a flashy Jaguar or something. A kind of modest family saloon could be quite expensive from a corporation tax, from a benefit in kind perspective. A real life case I was working on recently, the director had a car he was looking at. It's a £32,000 car, new, so a nice car, but nothing excessive. It was quite high emissions, and I'd worked out the director would pay £18,000 personal tax over 3 years of ownership of the car, which, when you think about it, is virtually the cost of ownership of that car. For a £30,000 car in 3 years, I'm no expert on cars, as anyone who's seen how old my car is that I drive, but you tend to think they'll depreciate around half in 3 years. So he's paying that in tax, and of course the company's also going to lose that in depreciation and running costs. So it became very expensive. The company would also have to pay about 6,000 Class 1A national insurance over that 3 years, pay the finance costs and all the running costs. So the outcome of that was it was much more tax efficient for the individual to take greater dividends to finance the car themselves, own the car personally, and charge the company 45 pence a mile. On the other hand, if you've got a relatively expensive and low emitting car, so the classic family runaround or second car, it can be a very low personal tax and have reasonable corporation tax relief. So there's often more merit in looking at the sort of second car as a company car compared to the main car. As with all things, there's never a catch-all. The circumstances do vary, but it's a fair rule of thumb for most people in most circumstances. As our question has alluded to, there is a separate benefit in kind if you have a company car and the fuel is provided, and this is normally very inefficient for most small business owners to have. And regularly I run the numbers and find that the tax you're going to pay on the benefit in kind is more than the amount of fuel you actually put in the car over the year. So it's an absolutely crazy idea to do that, because the company's still going to pay for the fuel and you're more than paying for the fuel direct. I've had a comment several times for people to say that the reason they like to have the fuel is it's easier. They basically can't be bothered with the admin of claiming back mileage. To those people, I said, well, actually, just pay the fuel yourself and don't bother claiming it back. Perversely, you're better off just paying the cost than you are paying the tax, which is a quite bizarre outcome. But it's, I think, fundamentally government policy. They don't like people having high-emitting company cars and fuel for whatever reason. So that's kind of the rule of thumb on that. And as I say, individual circumstances do vary, but it's rare that outcome isn't the position. Thank you.
Thanks, Alan. So question 6 then. With poor returns on money in the bank, and whereas over dilapidation charges and security of tenure in my rented premises, I've been thinking about buying my own trading premises for the company. It's been suggested that I purchase this through my own pension fund. What are the benefits of this, and how does it work? This is a very relevant question. It came up in conversation with a bank yesterday.
That's great, interesting. Again, this is something which is quite an established principle. So rather than having your pension fund with Aviva or Friends Life or whatever company, you can have your own self-managed scheme, and you have the option of using funds within that scheme to buy, rather than unit trusts, etc., which you might buy in a normal pension fund. You can invest in commercial property, not residential property, is worth pointing out. So the advantages of buying your own building through your company are there are several tax efficiencies here. First of all, you're going to have to seed the fund with some cash for it to put a deposit down on the building. You have to have at least a 2/3 deposit, basically, in law for a pension fund. So if you had a £300,000 property, you could borrow up to £100,000. So when you pay that contribution into the pension fund, that's a cost for tax purposes, so you're getting 19% corporation tax relief on that cost. Bear in mind, we all have an annual allowance, which is now £40,000 per individual per year, unless the high income restrictions come in for people with income over 150,000, which is we could do a whole new webinar on. But again, there is actually a fact sheet available on our website related to this for high earners. But for people who don't have that high income, 40k per individual per year, you can also normally utilise any unused relief from the previous 3 years. So you potentially could pay up to £160,000 per director into the fund on day one, obviously subject to having the cash flow. So that's one great benefit. the growth in value of that property is going to be tax-free because the pension fund doesn't pay tax. If you pay 300,000 for that property and in a few years' time you sell the company and you sell the building, the pension fund is not going to pay any tax on any gain on that building. Finally, well, in fact, not finally, the ongoing rent which the company pays to the pension fund is tax deductible for the company because it will be an arm's length rent, because the professional trustees of the pension fund will insist on that. So the rental you pay to your own pension fund, you save tax on in the trading business, and it's going into your pension fund tax-free. So it's a tax-free return on capital. And later on, what might happen is you might sell the business but retain the building in the fund, and then that rental income is used to pay yourself a pension. So again, that's tax-free income to the pension fund, although of course you will pay income tax on your pension income as normal. And finally, if you get in a position where the company has the company fund has excess cash after paying its mortgage back, for example, it is generally allowed to lend that money back to the company, if needs be, at a commercial rate of interest. So you're paying your interest with tax relief to yourself rather than to the bank, for example. So that, in a nutshell, is the benefits of structuring a property purchase in that way.
Thanks, Alan. Really useful. Like I say, it came up in conversation with the bank yesterday. They're finding more of their clients are approaching them because they're comparing what they're paying from a rent charge to what they could potentially pay by a mortgage. And provided they've got some cash for a deposit, it's quite an easy decision for the bank to make. So quite interesting to see those other options as well that you just referred to. So thanks for that. So got another question then that I've prepared in advance. So my income is around 115,000 a year, and I'm frustrated that I lose my personal allowance. What can I do about this?
Just to clarify, I don't think Mike was saying that was his personal question. So, in fact, this question is virtually identical to the question we had earlier around the child benefit. So although the numbers are different and the issue is slightly different in that once you have income over 100,000, for every £2 your income goes up, you lose £1 of personal allowance, and this gives you an effective 60% tax rate. The aims and the strategies to achieve those aims are very similar to our caller earlier with the 60k income and losing their child benefit. So we're going to look at, is there any income which could be shifted to a lower earning spouse? Is there a way to move that income into a tax-free environment such as an ISA, or convert it into capital gains which would reduce the taxable income, although not the practical income? Or failing all that, is there a way that we can get this person's income to be 100k one year or 130k the next year, to regain them their personal allowance at least every other year? For someone who's gaining back half of their allowance every other year, that's going to save about £4,500 in tax every other year when they get their personal allowance. So it's well worth looking at whether we can time income differently or time pension contributions and charitable gift aid differently to realise those kinds of savings. So relatively brief answer on that, because it is very similar in detail to that previous question.
Great, thanks. So I've got one more question, just to say again before I ask that final question. If you've got any burning question that you want to ask Alan, then please just drop that into the chat room, and we'll ask him that before the webinar finishes. But the last question I have is, we now have a £1,000 a year interest allowance, £500 for my spouse who is a higher rate taxpayer. As we don't have interest of anywhere near this, there is no benefit to using an ISA anymore, is there? That's an interesting question.
Yeah, that's a bit of a different question actually. So, many of you will be aware that as of last year, there was this interest allowance brought in where relatively high amounts of interest aren't taxable. So it does beg the question, to be fair, is there a point in an ISA? Because an ISA is just a savings account with no tax paid on the interest. I would say there is, because although at the moment you need probably £60,000–70,000 of savings to utilise your £1,000 allowance with interest rates being so low, first of all, obviously if you become a higher rate taxpayer, you need half as much in your savings account. But also if interest rates go up, then the amount, your threshold of capital you need will go down to break those thresholds. And although we have had a long period of low interest rates, at some point the world will return to normal, I would assume. I don't know when that will be. If I did, I'd be rivaling George Soros, but hopefully less unpopular. So reasons you might do it, like I said, I've already kind of mentioned two in the preamble, which is if you're going to be a high rate taxpayer, that allowance halves. If you're going to become an additional rate taxpayer, because your income's over 150,000, you lose that allowance entirely, and all your interest will come back into tax charge. A slight quirk as well is that although this is tax-free, that £1,000 or £500 is still counted as income for working out your band of income. So it will still use up your basic rate band or still use up your higher rate band, which is not widely understood point, and in fact the dividend allowance does the same thing, going back to our first question. Also this would count as income for things such as loss of child benefit and restriction of pension annual allowance. So if we need to reduce your taxable income because of the two scenarios that have been raised with us earlier on this session, then those funds being in an ISA is a good idea. I think also fundamentally ISAs and their predecessor, the TESA, which I do just about remember, have been around for decades, while the personal savings allowance is only a couple of years old, and you could view it possibly as a bit faddy or a little bit of a tinkering at the edge. And I'd probably view that the ISA regime in some shape or form is likely to be here for the long term, whereas this personal savings allowance could quite easily be taken away by a current or future government in a budget looking to reclaim a little bit of tax. So I think putting in something long term is possibly safer going forwards. If you are lucky enough to be under 40 or you're under 50 and you've previously opened a lifetime ISA, you can get a 25% bonus on your savings you make. So if you pay £1,000 into your lifetime ISA, the government will top that up with £250. The strings there, you can only use the money to buy your first home or in retirement, which means accessing it after you've hit age 60, whether or not you've actually retired. So again, that bonus isn't available outside of a lifetime ISA. You have to be under 40 to open one and under 50 to contribute to one. And lastly, I'll say that monies within an ISA, when you pass away, can be passed to your spouse into their ISA and stay within the ISA regime, whereas if you inherit non-ISA savings and the surviving spouse is already using their own personal savings allowance, they're straight away going to pay income tax on that income, whereas if it can pass into their ISA, the tax-free status is preserved. As always, look at returns on investment, not just the tax, but that's the tax angles to it. Okay, pass you back to Mike.
Super, thank you, Alan, and thank you for imparting your knowledge across those 8+1 questions. If nobody's got any final questions, then I'll just bring the webinar to an end. If there are no further questions, I just hope that the questions that I've chosen to cover today are the topics of interest to yourself. Certainly they're the hot topics that we're talking to our clients about at the moment, so hopefully they've also been relevant to you, or if you're also an advisor, the questions that you're being asked yourself. So a big thank you for you joining us today. We hope that it's been a good use of your time, useful use of your time to hear from Alan, hear his thoughts, and also not only just give you, like I say, the textbook response, but also some practical planning points that you may be able to think about or pass on. As someone that's joined us on our webinar today, we invite you to ask Alan a question offline if you want to. His contact details are there on the screen. And obviously, finally, a big thank you to Alan for giving up his time to answer the questions that I've put to him, to be the first person on our interview with this latest range. We have, as always, recorded our webinars, and these webinars are pushed to our YouTube channel. So in a couple of days' time, you should be able to find it on our YouTube channel. If you want to recap on any other points or just go through the webinar again in terms of content, your own pace. So thank you again for joining us, and please keep an eye on our events page on our website for our upcoming webinars and seminars. If you're local to Oxford, we've got a seminar workshop coming on the 21st of March, which is around the director's duties, and we're just finalising a date for April, which will be around SEO and pay-per-click advertising and seeing where the balance is. So again, more news on that on our events page soon. But finally, thank you again for joining us. Thank you for Alan, and I hope you can join us again for a webinar soon. Thank you very much.